Mortgage interest rates just reached their highest point since 2006. So what exactly has caused this run up in rates and what could we expect next? Let's get to the bottom line. Good morning. Lots of information to go over with you today, but let's start with what has been the highlight of the housing market news for this year, and that is mortgage interest rates. And rates have continued in the same trend. They've moved higher once again to 6.75% on average. And that puts us, on average, roughly 3.5% or a little more than 3.5% higher than at this same time last year. So, a continued trend, and that's had a huge impact on the market. We're looking for some good news, right? So one area of good news we saw was from Kathy Jones. She is the chief fixed income strategist for the Schwab Center for Financial Research. So impressive title, right? And she's knowledgeable when it comes to the bond market. She believes that the worst is behind us in the bond market, which would be great to hear. So the reason that she thinks that is the bond market is an early indicator. It's going to be a leading edge and react early to news of changes that are occurring. And that means it could also be one of the early signs of improvement before some other areas. So the other component is bonds have moved up and have a much higher yield. That actually makes them a much more attractive investment. So more money coming in and purchasing bonds could push the yields lower. So if we do see that, that would be good news for a potential improvement in interest rates. It's one important thing to keep an eye on, and certainly nice to hear at least some optimistic news when it comes to rates. When it comes to application volume, which is a real-time indicator week over week of the activity going on in the housing market, we saw purchase application volume fall 13% week over week. And that actually puts us down 37% year over year. So that's right in line with the trends we've been seeing, a much different housing market this year, 2022, versus the same time last year. Now, a lot of these topics have led to a question that we've addressed at certain points during this series, which is, are we in a recession? Well, we got the final reading for quarter two GDP, and that showed us that the estimated reading was accurate of negative 0.6%. So that's a confirmation, 2 quarters of negative GDP. And by most standards, that means we are in a recession. The official referee, though, for recessions is the NBER. That's the National Bureau of Economic Research. And they haven't yet classified this period of time as a recession. They need to look for a number of different factors in making their determination. They look for things like depth, duration, diffusion. So, different terms. They're looking at a lot of factors, but keep in mind, since 1947, so a pretty sizable period of time, we have never seen 2 consecutive quarters of negative GDP that did not get classified as a recession. And we're pretty confident that in time, this situation will not be any different. Now, Jake, one of the drivers for this whole conversation about the economy this year has been inflation. So tell us what we have for the latest data on inflation, specifically the PCE report we got recently.
Yes, sir. Thank you, Kyle. PCE, to clarify, stands for Personal Consumption Expenditures. And this really is the Fed's favorite measuring stick for inflation. Now, we just got the August report, which came back and showed that headline inflation rose again 0.3%. And that was actually 0.2% higher. So experts had expected it to stay kind of flat. We actually saw a bit of a rise. Now, year over year, PCE has actually fallen from 6.4 to 6.2%. And so that's great. That's what we want to see. Now, another metric to keep an eye on is the core rate. Now, what the core rate of inflation is PCE, but having the food and energy stripped out of that calculation. Now, when you strip those things out and you look only at the core rate, core PCE rose by 0.6% more than what was expected. So that actually pushes core PCE even higher, which is now coming in at 4.9% year over year. The reason we talk about this and why I want to make sure everyone understands this is important is because the core PCE figure is the Fed's main focus when they talk about seeing inflation around 2%. They're talking about this metric.
Yeah, thanks, Jake. Definitely a very important factor to keep an eye on for that reason. Inflation data is going to drive activity that the Fed takes. Activity that the Fed takes is going to have a huge impact on our economy and the housing market. And we, of course, want to know what's going on in the housing market and the economy. So that's why we're going to cover that information as it becomes available. It's particularly relevant this year, so we want to keep a close eye on that. Now, something interesting when it comes to the Fed is that recently they received some communication and messaging from the UN, the United Nations, calling on the Fed and other central banks to halt or slow their interest rate increases. So the reason that the UN is concerned with this and messaging with the Fed and providing this guidance and their opinion is that they're concerned the activity by these central banks could cause a global recession. And specifically that a global recession has a disproportionate impact on vulnerable nations. So when you look at it and zoom out for a second, the Fed has hiked the Fed funds rate at a very aggressive pace. It's gone from 0% not very long ago to 3.25% in a really short period of time. Our Fed funds rate is a full 1% higher than the next highest central bank and much higher than most other central banks. So because of this, our treasury yields have actually moved sharply higher, and that has become attractive for investors, in particular, some foreign investors. When we attract a lot of foreign investments, one of the things that they need to do is convert their currency into US dollars. And that conversion into US dollars has strengthened the US dollar significantly. That is actually another reason that the UN has been warning the Fed to stop rate hikes, because this exchange rate has a global impact and can really hurt smaller nations. So a lot of intricate details that come together, and we want to bridge that connection between what's going on in the world, what is happening, and then how does that in turn affect the housing market and our jobs as a real estate professional operating within this space. So we want to really give some context on what's going on and then bring it to the bottom line as far as how is that going to impact you as a real estate professional and the consumers that you're working with. So hopefully some of this information has been beneficial for you. We're going to continue to keep you up to speed on the most important information to be aware of on a weekly basis. So we'll see you back here next week on The Bottom Line.